To get going. Welcome in, everybody. Let's get going. Couple things to note before we get started. Again, just kind of briefly summarizing what we talked about earlier. Couple high-level bullet points here. At a high level, this should be running a little bit like a college or high school course where we build on difficulty and progress throughout the classes. We're going to try and add in some kind of Q&A or workshop section monthly through the 3-month period. Lectures are going to be every Tuesday, same time, same place for the next 12 weeks. And we're going to try and have some special guests throughout it and maybe add some surprise lectures if we can too. Let's keep it going. So yeah, just a couple introductions. So I'm in here. My name's Toasty. I've been giving lectures for, I don't know, almost 4 years, I think. Kind of scary. Developed this course kind of here at OOT, just from feedback from the members, figuring out what works, what doesn't. And then I'm also joined by MMA. He might contribute here and there. If you want to say hi real quick, Ann.
Hey, everyone. I look forward to learning with you all.
Yeah, so we're hoping you can learn, maybe not blow up the bit Unix anymore. But yeah, just a couple kind of class introductions here. So it's a 12-course series. Tonight, we're starting with stock options basics. Just as a note, this is called the beginner's course series. However, there's absolutely going to be relevant topics for everybody throughout all levels of experience. You'll notice the kind of difficulty begin to pick up once we start to get into about lecture 5 is when things start to get a little bit more difficult. And then 10, 11, 12 are really where we start to kick on the difficulty a bit more. But today is super high level. So this course really is meant to take you from kind of nothing to something as it relates to being a trader. You really don't need to have any knowledge at all as long as you can work your way around a computer or a phone today. And you're taking notes along with us. Recordings are going to be posted of every single one of these classes. I'd like to think that the titles of each class is reasonably self-explanatory about what we're going to do. But since we're a bit late tonight, I'll try and refrain from describing each class. But tonight, again, is really going to be covering the basics of the market and the basics of options. It's in the name, right? Only options trades. So we got to make sure we at least introduce with the instrument that is kind of our primary focus in here. One thing that I want to outline is just kind of a high-level goal for the course as well, and all those who attend. I'll just read it as you guys read it as well. The goal of this course is to develop successful traders who can find and execute on the highest probability trades and act on those opportunities with confidence. And both pieces of those statement are reasonably vague to an extent, but I think it's a much better goal than something like make a lot of money in a short amount of time or not blow your port. Because fundamentally as traders, right, if you take nothing with you from this class, at least hopefully you remember this, all we can do is play the game of probabilities, right? There's no way that anything is ever going to 100% work every single time in the market. So all we can do is stack different probabilities in our favor in order to have a higher probability of being correct on any given investment or trade or scalp or whatever you want to call it that we find ourselves in. And ultimately, it's important to be able to have the confidence to act on those opportunities once we find them, because you could go through this whole course, you could have, all your technical analysis memorized to a T. You could be great at reading charts, great at understanding price action, and just be too scared to execute any of those pieces of analysis that you take. So real second kind of important piece of that statement. So continuing to move on here, just to kind of summarize briefly, the two kind of main things that we're going to cover tonight are what is the stock market and what are options. Again, really, really high level questions here, but hopefully this is a real good introduction for everybody. Last chance, any questions before we get into the content? While I wait for any questions to come in, one other thing that I want to note, if you guys do have any questions or comments, just go ahead and throw them in the chat whenever you like. There's a lot of you in here tonight, so if it starts to come in a little quicker than we're used to, just go ahead and send the question twice. Probably just missed it. So, and we also have Emma in here. Maybe he'll be able to address some of those questions in the chat as well. All right, and yeah, again, just really quick before we get started, I want to thank you guys all for making the time to be here tonight. Maybe you can't tell, but both MMA and I, and hopefully the rest of the team are really excited to be able to provide this for you guys. It's not every day that we get to have, this kind of official sort of course series that we get to go through. So hopefully it's exciting for you. It's definitely an exciting day and a couple months for us. So definitely looking forward to it. And hopefully we can find ways to keep your attendance throughout the course series. All right, let's get right into it. First, we're going to start by answering the question, what is the stock market? One thing that you guys are going to notice is as I define things throughout the course series, very typically the definitions that I provide are reasonably vague. I tried my best to give definitions and things kind of in my own words rather than, just the AI overview from Google. So it's going to be a little bit vague. We're going to introduce some new terms to you guys today, but yeah, let's get right into it. So what is the stock market? The way that I define this is any marketplace where the trading or exchanging of securities occurs. And again, really, really high level stuff here. So digging down into some of these terms, right? I think the first one to probably explain here is securities, right? What could that be? It could be a futures contract, right? So it could be oil or gas or S&P 500 futures. It could be some derivative of an equity. So that could be an options contract or some kind of warrant. It could be an equity, right? Just pure common stock. So there's a lot of different types of things or assets that can be traded within the marketplace. And as a result, we kind of refer to the stock market as just the marketplace where we can trade all sorts of things that kind of fall under that securities umbrella. So again, it could be some kind of ETF, maybe an ETF that represents the price of gold or Bitcoin. It could be a futures contract that represents the price of gold in 6 months. It could be, a multitude of things. So generally speaking, the stock market is where we can trade those sorts of securities. Just a couple different terms to define here. There's a couple different terms that you may or may not hear as you kind of go throughout your trading process. And these are kind of some of the main components of the stock market. So obviously the market itself is kind of the machine that connects buyers and sellers. So some analogy to the stock market could be something like eBay or Craigslist, where somebody has something to sell and that platform is used to connect that seller to a buyer. That's more focused on the stock exchange. I guess the stock market is a bit higher level. The exchange is where those transactions actually take place. So again, that could be something like an eBay type of platform where buyers are directly connected to sellers. In the stock market itself, some stock exchanges could be the New York Stock Exchange, the NASDAQ. There's plenty more exchanges that are a bit more lower level than that, but those are kind of the highlights. And then the kind of next term for us to define as a stock index. So the indexes are probably names that you've seen if you've ever watched the news or ever been on Google or even Windows PCs. Sometimes just by default show you the performance of the most kind of common stock indices. Some names of some common stock indices are going to be the S&P 500 index, the NASDAQ 100 index, the volatility index or the VIX. So a whole lot of different sorts of indices, but there's definitely some real common ones that are kind of used to convey the performance of a group of stocks, right? So the S&P 500 is used to track the 500 most kind of popular, I guess I'll say, companies, and that's chosen by a board who kind of picks who's in and who's out. The NASDAQ 100, generally speaking, represents the top 100 non-financial companies. About 70% of that is concentrated in tech. And then the Russell 2000, that's generally comprised of about 200 or 2,000 smaller cap companies, so a little bit smaller in size compared to the NASDAQ and the S&P. So these are kind of three terms that you're going to hear throughout your trading journey. There's definitely more to talk about in these specific terms, but just trying to keep it high level. Don't want to overload everybody too early in the course. Moving on a little bit to the next kind of idea. The stock market fundamentally is a zero-sum game, and that can be referred to as the auction market process. Basically, there's always a buyer and always a seller for every transaction. So if I list some amount of stocks to sell on the market, there's always going to be some buyer who may want to buy those amount of shares. And you can think of that like anything, right? The grocery store is selling you 1,000 different bell peppers for 99 cents a piece. And there's some people who are going to come in and buy, X amount of those bell peppers. Fundamentally, it's a bit different though, as there's more of an auction. So for example, you wouldn't expect to go into the grocery store and say, I only want to pay 50 cents for those bell peppers. That's not an option for you, right? You're going to pay the list price or you're not going to get the bell peppers. Where in the marketplace, there's a bit of a kind of different accommodation to that. And that can be referred to as competitive buyers or sellers. So basically, the price of a stock or a security or an equity or an option contract is, generally speaking, the highest price that any buyer is willing to pay. So in the example of maybe some quantum stocks that have been kind of the focus of a lot of investors recently, if those are trading at 6,000 price to sales, ridiculous valuations, but people are willing to purchase the stock at that valuation and that price, well, that's the price of the asset. And once people are no longer willing to pay that price, that's when the price begins to drop. So generally speaking, that price is reflective of the balance between buyers and sellers. So as the amount of demand or the amount of demand from buyers increases, generally speaking, the price of an asset appreciates. And as the amount of pressure from sellers increases, that is typically proportional to the amount that a price of an asset decreases. And at any given moment, the stock market has millions and millions and millions of buy and sell orders at any given moment across every asset class, across every type of asset. There is so many people and algorithms and computer programs, whatever it might be, trying to buy and sell stocks at any given time. And for the most part, a lot of the stocks that we're focused on trading here in Only Options Trades are very highly liquid, meaning that if you press the sell button on your brokerage, you're going to get cash back for that sale immediately, or you're going to send a buy order in your brokerage and you're going to be able to get those shares pretty much immediately. Now obviously there's some caveats to that, but for the most part, the stock market has only grown in more popularity over the years, as I'm sure you guys all know. There's 160 of you in here. I assume probably 80 to 100 of you probably already own some stocks in some 401k or Roth or other investment vehicle. So really, really popular, and it's only gotten more popular over the years. And this is basically how the market works, right? If it's foreign to you, you could think of it, going back to that eBay analogy, right? Hopefully eBay is reasonably simple to understand. A buyer might list a PlayStation 5, or a seller might list the PlayStation 5 for say $250 and start the auction there. And if somebody wants to pay that price, they'll, say they want to put in that bid and maybe bid it up to $255. And then if somebody wants to pay $255 for that PlayStation, maybe they'll say, okay, I'll maybe pay $257 for that, et cetera, et cetera. So the market and price of assets is fundamentally set by the imbalance between buyers and sellers. I know we've covered a lot. It's already been 10 minutes and it feels like we've kind of move pretty quick. Any questions or comments that I could address so far? Helmi has an interesting question: when to trade options and when to trade stocks. This comes down to kind of a personal risk tolerance sort of question. Fundamentally, the question is one that only you can answer, but some general guidance on kind of, at least that I take from my own portfolio and investments, on when to trade options versus when to trade stocks. I'll typically trade stocks more during elevated periods of volatility or higher risk environments. So for example, right now in the marketplace where we're experiencing that more elevated volatility, some of those more significant distribution days on the indices, that's when I'm going to be more kind of lenient or tend to purchase equities more than the option contracts, as opposed to when we're in kind of more of a, I'll say, stable or lower volatility environment. For me personally, that's typically when I trend back towards the options a little bit more. That's just me personally, and that's my own risk tolerance. Some people might be the complete opposite, where they want to be trading those options in the higher volatility environments and want to stick to shares in lower volatility in order to capitalize on that volatility. There's no right or wrong way to trade in the market. So if there's no buyer, what will happen to the contract? Yeah, so you could think of it like, if you're trying to sell something online, right? If you're trying to sell something for $450 online and nobody wants to pay $450, what can you do, right? Either you can take that thing off the market at the time and say, I'm going to wait for another time when there's buyers, or you can start to drop the price and see if you can attract a buyer. Now, generally speaking, the way it works in the stock market is if somebody isn't willing to pay $450 for something, it doesn't just disappear off the marketplace, but rather the price drops. So for example, if I say that Google is worth $200 per share and there's not a single person who wants to purchase Google at $200 per share, well, I'm going to need to drop my price if I want to find a buyer for the shares that I'm trying to sell. Helmi asked the question: is there any limitations on how much money or how many contracts we can buy? The answer is theoretically no, but practically there is limitations. So for example, Robinhood sometimes won't let you trade more than like 200 contracts of any given position. Generally speaking, there's regulations around the amount of option contracts you could trade in any given month. I believe if you trade around 200 or 2,000 contracts in a month, you'll start to get questions from your brokerage if you're, a professional trader. And just because you trade a lot doesn't mean you're good or a professional, but that's just kind of the first thing that they go to. Is most retail traders aren't going to be hitting, thousands and thousands of contracts in any given month. It's usually a bit more tame than that. So the answer is no, there's not limitations. I'm sure you could find your way around any that come up, but for the most part, everybody in here probably wouldn't hit any of those limitations unless you're trading options with, realistically hundreds of thousands of dollars is when you'll start to find some of those limitations. But for the most part, that's kind of unreasonable. All right, so I want to move to just kind of a quick graphic that describes what we talked about here and kind of the auction market process. So you could think of this line graph as kind of a real simple stock market chart, right? I'm sure everybody's probably seen or heard of some kind of line chart that just reflects the price of an asset over time. And focusing in on kind of a more simple example or more relatable example with a new vehicle, right? So let's say, for example, the dealer lists some vehicle with an MSRP of 35K, right? And let's say, for example, that price stays stable for a while. There's enough supply to sell the cars to the amount of people that want them. And let's say, for example, all of a sudden, there's some kind of crazy change with this car that makes it a lot more rare or a lot more special or a lot better than it was before. And that could be some kind of event, right? And you could think of this back to stocks as maybe an earnings report or some crazy piece of news that has been released, right? So for whatever reason, people want to buy this car more than they did over the last few months. And all of a sudden, that would create some kind of buy imbalance where there's more buyers than there is sellers, or there's more demand than there is supply, right? For any new car market, there's a limited amount of cars on the market at any given time. And if all of a sudden double the amount of people want to start purchasing those vehicles, well, generally speaking, the price is going to go up. And as a result, that price of that value or price of that vehicle may increase up to 40K. It may stabilize around that same place. And again, thinking about the same type of market event, but in an opposite scenario, let's say, for example, a new vehicle was released that has a better price, that has more features, it's got more color options, it's got more upgrades, whatever it might be. And all of a sudden, less people want to purchase this car now, and they want to go purchase that other car instead. Well, all of a sudden, there's probably going to be more cars on the market than there is people willing to buy them. And as a result, the price will have to drop till some new level where buyers once again become interested. And funny enough, we interact with this process, maybe not on a daily basis, but I'm sure a lot of us have, maybe purchased a vehicle or something online and maybe experienced some similar types of things. And you could even probably see this maybe in grocery stores when they offer sales on items. Like, I mean, this is all over daily life. Like, for example, if I'll go back to, the produce example, if there's a whole lot of produce that's going to go bad soon, well, the store might have to drop prices on that in order to get some money out of it rather than nothing. So they'll offer some kind of sale, right? Just kind of connecting that back to day-to-day life. Do different stocks ETF have different tax cuts? Yeah, so I think MMA answered the question there. So trading, your SPX, the NASDAQ, and the VIX, yeah, I think the answer in the chat really covered it there. 60% of those taxes go to long-term and 40% goes to short-term. The general rules around taxes when trading is that any position that's held under a year duration is going to be taxed as short-term, which is just going to correspond with your standard tax rate. And then if you hold over a year, it's going to then be taxed at the long-term rate, which I think the floor for that is 15%. And I think it scales up to 22 and a half, but I can't remember. I don't know if that's changed recently. Everybody good on kind of the fluctuation in at least this specific example? Believe it or not, this applies to stocks probably more than you realize. And one thing that you guys will notice with the lectures that I like to give is I do my best to give a lot of analogies, because at least for me, I think it would be helpful to have these sort of analogies when I was learning all this stuff for the first time. So this is really the reason why the price of stocks go up and down, right? Fundamentally, if there's more buyers than sellers, the price of a stock is going to go up. If there's more sellers than buyers, the price of a stock is going to go down, right? That's it. Now, obviously, there's going to be reasons why there's more buyers or more sellers at any given moment, but fundamentally, buyers and sellers are the only thing that moves the marketplace. That's it. Any questions on that? That was kind of the last kind of piece that I wanted to cover there for the stock market basics. And then from here, we'll move a little bit more into options. Anything to add, MMA?
Um, no, I did want to talk about just briefly, uh, as he was talking about risk tolerance with options and stocks. I know many of you have probably noticed over the last year, I was mainly trading stocks just because over 2022, 2023, I was doing options like crazy. And, I had my success, of course, and definitely some L's I took. It was very volatile, as he was saying earlier. I was trading SPX, and that was like, it felt like my heart was pumping every day, you know what I mean? A little differently. And I'm sure a lot of you can understand what I mean by that. But in 2023, a lot of these stocks I was these options I was trading with SoFi and all that. SoFi was so stagnant over the last year or so. I was getting crushed on options just because I was kind of buying leaps, but there was, when the stock doesn't really move, you're gonna lose time value on those contracts. So like I'm sure I don't know if a lot of you trade leaps. I know a lot of you do short dated. Um, if you're someone and you believe in like a company or maybe even a certain sector that you're investing in, it's never a bad idea to buy shares. Just because if you're like, hey, I'm thinking in the future, at the end of the day, I hear a lot of people be like, well, Nvidia is like the best company in the world. Why isn't it going up? It's because a lot of times these short-term fluctuations are there to kind of shake people out, especially as short-dated contracts. So like if you're someone who you don't want to, if you're someone who's maybe taken some L's recently, short-term trading, short-term contracts, it might be beneficial for you to start building that long-term port. I know a lot of people aren't working with the craziest amount of capital, right? But just even starting a long-term portfolio will help you kind of understand the market a little more, and it'll actually like, build up your confidence a bit too, because if you're someone who you seem to have the right picks, just maybe the wrong timing. I mean, hey man, the share game, I promise you, if I can do it, any of you guys can do it. But yeah, what he said was spot on as well. It really depends on your risk tolerance, but I think a lot of people in here are doing really, really short dated stuff. There was a guy in the chat, he did some Nvidia calls or something, they expire Friday. I mean, Nvidia could stay at this 140 range, right, until Friday, and then Monday it gaps up to 150, and your contracts are expired. You know what I mean? Like completely worthless. So uh it helps to buy a little longer dated, or if you want to start buying some shares, man, check out my tab. And I know Toasty probably buys some shares as well. So it's not like even if we're option traders first, we all definitely invest as well. Tilio invests. We all, have our own portfolios. So and you can get big gains just trading stocks like PLTR went up from 15 to 80 or something in 1 year. So I just wanted to touch on that because that was a question I saw, and I know a lot of people ask me that same question every day, like should I buy stock or should I buy options? And to me, it really depends on your risk tolerance and what you see the stock doing in the short term and the long term, and that'll give you your answer. So it's never bad to do both too, if depending on your confidence on it. But at the end of the day, shares usually don't expire unless the company, ultimately goes bankrupt.
Right.
Usually that's not going to happen, right? But yeah, I love the questions, guys. Anything you guys want to ask, I'll try to answer it as, and same with Toasty. We'll both try to answer it. We've seen various markets in the last 5 years just being in OOT. So, and I know a lot of you have as well. You've been with us for a long time, some of you. So, but I love learning in this type of environment. I think it's very helpful. But any questions, I will, like I said, we'll both answer whatever, but I'll let you continue, Toasty.
No, I appreciate that. And I think that's a really good point to highlight too. Part of introducing the shares piece of things is that, like I mentioned, obviously the focus of a lot of the alerts posted in here are certainly options. But there's a statistic that you're going to hear thrown around a lot, something like 90, 95, 99% of all traders fail. And there's a very good reason for that, right? Fundamentally, when you're trading short-term options, you got to be pretty damn good to be successful long-term, right? There's so many people online and on social media. It's just not things that you can really fall into. And I mean, even the stuff that MMA posts online, it's not. It's a marketing game, right? That's
Yep.
really what it is. And not
Yep.
to take anybody down here. Obviously, it's great, but it's all there's an agenda behind it. So don't fall, for those kind of social media things. I
Yeah.
guarantee you, even a
Yeah.
lot of those people that you see online, they don't make money. So focus on your education,
Mhm.
focus on learning. Everybody who's in here tonight is doing the right thing. Trying to learn first before you guys get too crazy into trading. So yeah, let's keep it going.
Yeah,
All
perfect.
right. So the next kind of basic question that we wanted to answer tonight is really what are options? And just so you guys know, in this section and throughout the rest of the lectures, I like to have some kind of questions that I pose to you guys just to kind of check your understanding, check your engagement, that sort of thing. So this section's got, I think 2 or 3 questions in it for you guys to respond to. So we'll get to those, but hopefully those are a little bit helpful too and provide some nice discussion there. So moving on to the basics of options. Options are kind of simple and kind of complicated depending on how hard you think about them. We'll start basic here. There's really two types of options: call options and put options. Call options typically gain value when the price of the stock increases. And there's a very intentional reason that I use the word typically. Just because a stock goes up does not mean the option contract will also increase in value. And that is a lesson that so many people refuse to listen and just have to learn it for themselves. And I'm hoping for at least one of you, you can avoid that same learning lesson. The scenario where this comes up is, oh, I'm going to get calls for earnings. Oh, the stock goes up, I'm going to make money. And then all of a sudden you're down, 50, 60, 70% when the market opens. The options market isn't so simple, right? There's actually a very complex pricing equation that goes into determining the price of option contracts. And as a result, right, the options market knows when a stock is going to move significantly, right? And we'll talk about that in the next lecture, what that looks like. But that's a really, really important thing to understand. Hey, we got Flips in here too. Welcome in, Flips. Let's get everybody up. Everybody up. Yeah, so two main types of options here: call options and put options. Again, calls, you're going to see that's what typically gain value when the stock price increases, and puts typically gain value when the underlying price decreases. Now, options fundamentally exist for a purpose, right? They weren't always meant to be traded the way we do. And we'll talk about kind of what the fundamental purpose of options actually is. I'm sure some of you who have traded options have probably seen it before. That exercise button, that little exercise button that you don't know if it means you're going to go to the gym or if something else is going to happen. But that actually does mean something. We'll talk a little bit about that. So here's what kind of the profit and loss profile may look like for a call option. Again, very, very simple stuff here, but this is kind of the price of a call option at its expiration. And I'm going to talk about some terms here that we don't know the definition of, but let's say, for example, the strike price is 105. Any price above 105 would mean that we would be at least in the green or have some kind of value at expiration, anyway, I'll try and not get too deep into those terms. But generally speaking, the kind of profitability or profit or loss kind of graph of a call or put is reasonably straightforward. The maximum amount you can lose in any stock option is the amount you pay. So anything that you buy to open in the market, the most you can lose is what you put into it. So if I spend $500 on calls, the most I can lose is $500. If I spend $500 on shares, the most I can lose is $500. Now, hopefully you think about risk in a little bit of a different way in most scenarios, but that technically is your maximum risk. And one interesting thing to not get too caught up with, but technically the profit of calls is unlimited. Technically the profit of buying shares is unlimited, right? A stock could increase to infinity, an option could increase to infinity. Now, is that ever really going to happen? No, but it could, right? So I don't want you to think too hard about that. So talking about kind of the fundamental reason why options actually exist, a call option gives the owner of that contract the right to purchase 100 shares at the strike price of the contract, and a put option gives the owner the right to sell 100 shares at the strike price of that put option. You'll hear the term hedging from time to time, and the reason that these options were originally created was for portfolio managers and just investors in general to do what's called hedge their portfolios, or effectively you could think of hedge as another term for insurance policy. So let's say, for example, I'm in, say 1,000 shares of Google stock, and let's say, for example, I don't want to, maybe sell at the moment, but I think there's maybe some downside risk in the company at any given moment, right? For whatever reason, I could buy a put option, and if, for example, the stock price decreases significantly, what I could do is exercise that put option, and it would allow me to sell shares higher than the current price in that specific scenario. So let's say, for example, I buy a 200 strike price put option, and the price of the shares drops to 100. Well, I can exercise that option contract, and I'm able to sell my 100 shares at $200 per share, even though the strike or the current price of the shares is $100. So I get, $100 of value on a per share basis, which, would be significant. Obviously, that's a scenario that's really blown out of proportion there. But anyway, that's kind of the fundamental reason options exist. Let's talk through a couple examples that might help understand better. So I have, a chart back from early 2024, the SPY here. And here's maybe an example of how calls may work. So let's say, for example, you have a call with a strike price of $470. Let's say, for example, you paid $500 for that contract. Well, your break even on that contract would be a $475 stock price. Because if you think about it, right, if you pay $500 for a contract, you would need the price of the shares to increase $5 per share in order to break even on that contract if you were exercising it. And I know maybe this is a little bit of a convoluted explanation. Generally speaking, the way options contracts are priced are in a per share basis. So let's say, for example, the price of an option contract shows as 5.00, which looks like $5. You actually have to multiply that by $100 to get the actual, or 100 shares to get the actual price of the contract, which would lead to a $500 price paid on that contract. And then ultimately, if you're $500 in the hole, you own 500 shares, you would need those shares to increase by $5 per share in order for you to break even on kind of that investment that you made in that call contract. So again, right, just another way of thinking about it. Might be a little bit confusing still, but we'll keep talking about this. I know this is where things kind of get a little bit silly. So anyway, kind of the converse example here, if we talk about, a put contract with a strike price of 430, let's say, for example, again, we pay, let's say $300 for this put contract. We would need shares to drop to $427 in order for us to break even on that investment into the put contract. So just kind of a summary of kind of the different things that you can do and adding a bit of complexity here. Let's just focus on call buyer and put buyer for a bit. Again, right, the call buyer is the right to buy the underlying or given equity that you're trading options on at a specific price on or before a specific date. And again, we're going to continue to define these terms, and this would be a bullish position. A put buyer would also have the right to sell the underlying at a specific time, at a specific date. And again, right, this would be a bearish position. Now, as we mentioned earlier in the lecture, the market is a zero-sum game. And in order for you to buy a share, somebody needs to sell you that share. The same thing goes for options contracts. In order for you to buy a call, somebody needs to sell you that call. So every time you buy, let's say 10 call contracts, there is some person, some fund, some individual entity in the void that has sold you those 10 contracts, and they have basically taken on the opposite positioning. For the purposes of this lecture, I don't want to get too far in depth into this. You can take a look at this graph, screenshot it later, and take a little bit more time to review it. But generally speaking, those who sell calls or sell puts are kind of taking on the opposite positioning. The reason I say kind of is because the Greeks kind of make that a little bit more fuzzy. So we'll talk about that in our next lecture on what the Greeks are and how that impacts these specific scenarios here. So let's talk about some of the properties of an option contract. So this is a good old Robinhood screenshot. This is probably a year or two old at this point, but still holds true. You're going to see your option contracts look really, really similar when you pull them up. Depending on the brokerage that you're trading on, it's going to be a bit different, but this is really the idea here. So with every option contract, it's going to be associated with some ticker, right? As a note, option contracts are called derivatives for a reason, right? They are derived from an asset price. So as a result, you can't just buy an option on nothing. It's got to be related to some stock. So in this case, the stock was the S&P 500 ETF, which is SPY. You can also see that we have a strike price of 400. Yeah, this was definitely a bit of a YOLO. I think I got this specifically for this example. Yeah, this is funny. It expires in 2 days. The current price, it's $15 out of the money. So yeah, don't take this as an example for a high quality trade. But anyway, the contract is going to show as a call or a put. So you can see this one in this example was a call. You can see the number of contracts that you are in, the price that you purchased the contracts for. So notice again, as I mentioned earlier, this shows kind of, it looks like dollars and cents, but again, really you have to multiply this by 100 to get the actual value of the contract, which you can see here, right? It shows the market value here, pretty nice. Current price as well, again, shows in a similar kind of dollars and cents type of format. The expiration date and the potential or current gain or return on your given trade. Now, one thing to note, and the questions that you're probably having, is that options provide significantly more leverage than just purchasing shares. So for example, let's say I purchased a call and immediately the share price rocketed 5%. If I had just bought shares, I'd be up about 5% on my return. If I bought an option contract, I could be up, 500% based on the contract that I chose, or 1,000% based on the contract that I chose. So there is a significant trade-off in terms of the leverage that you can get from options. Now, obviously, that's a benefit for some reasons and a con for other reasons. And there's two kind of main factors that control the, I'll say, magnitude of the leverage that you get. And we'll again focus on this more in the next lecture, but just to introduce a couple concepts now. Generally speaking, the closer you are to expiration, the more volatile an option contract will be. And there's a bit of a caveat to this next statement, but generally speaking, once you hit kind of that sweet spot for out of the money, the more volatility that you'll experience. And we'll define what that term is. But anyway, there's kind of two levers that you can pull to increase the amount of volatility or potential return or loss that you could experience from your option contract. And there's definitely a time and place to pull both levers depending on what you're trying to do. So again, just kind of deferring that conversation till later. Just want to introduce that concept to you and guys, let you guys know that it exists and is something that is important to keep track of. And just another example here, this was an example of what option contracts look like in the port on TD Ameritrade. Rest in peace to TD Ameritrade, but still an excellent example, and I'll relive this anytime I can, but because this is beautiful. But again, right, any brokerage that you trade on is going to have a real similar sort of user interface in terms of the content provided. It's just going to be presented in slightly of a different way, but again, same idea. Did I succeed in that Robinhood SPY deal? No, I think that went to zero. I think I literally just bought that for fun, just for this lecture, so I could have it in here. But I'm pretty sure it went to zero, unless I sold it immediately. I don't know what I did with it. This Zoom call, I mean, this was 5 years ago at this point. I don't know what happened with this. Couldn't tell you. But this is when Zoom was all the way up at 450, so must have been quite the exciting month for me. Anyway, again, same idea. I'm not going to kind of repeat everything that we covered so far, but same idea, just presented in a slightly different manner. And one other thing that I wanted to cover really quick is just the way to purchase an option contract. So this was, again, I don't know how old the screenshot is. This looks like around the same time the last one was, but this is kind of the workflow for purchasing an option contract. It's going to depend on your brokerage, so I'm not going to focus too much on exactly what's going on in this specific screenshot, but basically there's what's called an options chain, which we'll talk a little bit more about that in future lectures, that lists all the options that you can buy, all the strike prices, all the expiration dates. So there's a large variety of contracts that you can pick from, a time and place and a reason to be trading each and every one of them or not be trading any one of them. There's definitely some reasons to not trade a lot of contracts. The one thing that I wanted to highlight and kind of introduce to you guys is this bid and ask price. And I see your question, DJ. I'll get to that in just a second. This bid and ask price is one thing that I wanted to highlight. This takes us back a little bit to the auction market process, where the bid price here is what any buyer is willing to pay. And the ask price is the kind of minimum price that a seller is looking to get for their contract. So if, for example, I wanted to immediately purchase one of these SPY calls, I would basically put my fill price directly at the ask, right? Again, you can think of this as kind of seeing something on, say Facebook Marketplace or eBay, seeing the list price and say, yeah, buy it right at that price. I'm gonna come pick it up right now, right? That's basically what you're doing when you're putting in the ask price for your fill price. The bid price you could think of as, sending somebody a message on that Facebook Marketplace and say, hey, I know you're asking 350, but what do you think about 100? That's basically what the bid is. And, for the most part, it's not always going to be that lowballed, but on this specific instrument, you could see the bid and the ask are real close together. So this is going to be a nice, easy one to trade. But as those bid and ask prices start to spread out between each other, there can be a bit more nuance to trading those specific derivatives. It can be a bit more sketchy sometimes, and you got to be a bit more experienced to really understand what's going on there. I know some traders in here, specifically River, loves to finesse those sort of trades where, he'll just put a limit order at the bid and, stupid people are going to market sell to him, and then he can try and put a limit at the ask and stupid people market buy from him. So there's definitely a time and place to try and finesse that sort of thing, maybe some kind of arbitrage trade. But for the most part, it's probably something that a lot of you, especially if you're new, should just try and stay away from. DJ asked a question, what broker do I recommend? If you're asking for my personal opinion, I think honestly, Robinhood, it may be embarrassing for some people. I think Robinhood for trading is actually great for beginners. I will say for charting, it is, I don't know if it's gotten better. I don't even try, but it's not something to really use, at least in my wheelhouse. But I think Robinhood as a broker is superior to most others. At least they've gotten a lot better, in my opinion. They're no fees. They got a lot of cool features, matching deposits, that sort of thing. So I think there's a lot of benefits to it. I also, am a fan of Thinkorswim, which is a charting platform, which is now owned by Schwab. Not as much of a fan of Schwab as a brokerage. I know some people like E-Trade, some people like Fidelity. If you're out of the States, you got to use probably iBroker, Interactive Broker, I think is what that stands for. But those are kind of the high level ones to be paying attention to. Some people, I think some people use like Chase as a brokerage, and I think SoFi is not that great for options. I probably wouldn't recommend that. As a former E-Trade engineer, I recommend Thinkorswim. Wow, that's very interesting. JT, I'll probably have to talk to you about that a little more. That's actually very interesting. Webull, I'm personally biased against. I think it's I just don't like it. I don't think it's very good. Can you put a stop loss on options trading in Robinhood? The answer is yes. If you want to buy a contract, you can set it at the option price or the stock price. You would set it at the options price. You're using TOS before Schwab took over. Yeah, me too. I still use TOS, but at least for the last couple of months, they weren't really updating anything. It seems like now they're finally starting to make updates again to it and improving the platform because it definitely needs it. But anyway, you can't knock TOS. I mean, it's about as good as it gets for a free software, basically, that gives you live data and all the features that you could possibly ask for. All right. Let's see. I have this next slide. Okay, after this next slide, I'll take a quick pause. Again, out-of-date screenshot here a little bit, but this is basically what the options chain might look like on your brokerage. Just another example of it here. You could see a couple different screenshots here. On the left, you can see the bid and ask price for these specific contracts. So this shows all the strike prices in the center column here. These drop downs show different expiration dates. Again, the strike prices we'll talk a little bit more about, but basically the strike price that you want to be trading for the most part shouldn't be too much different, like much more than 10% of a difference from the stock price. It's a great rule of thumb as a beginner. If the stock price is $300 per share, you probably shouldn't be trading any strike price higher or lower than 330 or 270. That's just a great rule of thumb to start from. Obviously there's a time and place to fine tune that for any given trade, but as a beginner, right, really not much of a reason to go too far out of the money. You want to keep it a little bit closer to the money. Things will move a bit more naturally for you, and the volatility will be a bit more minimized. Outside the United States, I believe you have to use a different brokerage. I think a lot of the US brokerages that we use don't quite allow international folks. I think, at least I don't know. Honestly, I'm not super educated on that. I guess I've never had to be. But anyway. All right, so I wanted to take a quick pause here on this one. I know we've kind of covered a lot. We've really flown through a lot in the last 40 minutes. So just wanted to take a quick pause and get your guys' feedback while we still have a majority of you here. What are you guys thinking? How's the class setup going for you guys so far? Go ahead and put it in the chat. Are you guys enjoying the format? I know it might be a little bit basic for some of you, but what are you guys thinking? How are we feeling so far? Is this something that you're excited to continue with for the next, 11 weeks now? Yeah, definitely a lot of info. I'm not gonna lie. Yeah, it's we're moving kind of quick, and me personally, I find myself talking a little bit quickly sometimes, so I do my best to slow down when I can. But um, yeah. Hey, Husky's in here. Husky doesn't even need to be here. Good to see you, dude. That's awesome, Errol. Yeah, glad to have your son in here. Shout out to him. Good to hear it, Levon. Yeah, awesome. Yeah, probably need to rewatch the video. That's all good. Yep, it's recorded for a reason. More examples from traders and screenshots will be nice. Yeah, absolutely. The future lectures are going to have definitely more examples. This one's super basic, so doing our best to kind of keep it a bit more high level and not get too down into the nitty gritty, but understood. Yep, more practical approach as well, George. Absolutely. Yep, we will definitely get into that more in the next couple of lectures. Obviously, this is still kind of just building that foundation, but don't fret. We'll definitely get into more practical ideas. All the concepts that we learn, we're going to be applying, with real trade ideas, real charts. I'll be doing my best to document, the ideas that I use from these lectures and the trades that I take, and we can even try and recap those in the class and just kind of talk through them, what went wrong, what went right, that sort of thing. And I'm sure others will be able to do the same for us and kind of talk about how they're kind of using these lessons to their advantage. So, definitely the first lecture or two is probably going to move a bit slower in terms of the practical applications, but absolutely we'll get there. Yeah, videos on entering a trade and setting a limit order. Yes, some of those we actually have already in the channel. If you look, you should see in the brokerages tab here, there should be some good videos on setting some stuff up. So just kind of some tutorials, options trading, some stop loss setting, trade execution. Definitely, there's probably some out-of-date info here, but fundamentally it's still the same. So these videos are all in here. Again, back from 2021, but they are mostly about the same as they used to be. So yeah, I would recommend you just taking a quick look at the brokerages tab in here. I'll just go ahead and send you the link to the tab in the chat so you can refer to that. But yeah, should be a good starting point for you. Yeah, I need a video on flips, enters, trades. Yeah, I could probably use that myself too. He's kind of all over the place sometimes, huh? He's kind of a real crick in and out. I don't know. He's like drinks like 6 cups of coffee before he gets on the mic in the morning, and all of a sudden he's taking 10 trades in 5 minutes. I can't keep up either. All right. Is there a video on the Discord on how to put a stop loss for Robinhood for options trading? The stop loss probably not specifically, but that doesn't mean it's not something that we could create. All right, let's keep it going. We got a couple more slides to get through before we call it for the night. Oh, one more question. When buying an option, is it more beneficial to buy multiple contracts at a lower entry to trim if in profit or stick with one at a higher price or vice versa? Yeah, so as a beginner, I think the most important skill to learn as a beginner is managing your positions and obviously also getting into good positions. As a beginner, generally speaking, I like to recommend to people to just trade one contract and just sell at your first profit target and close the monitor, stop trying to trade any further. That's, I think, the best advice I could give to a beginner. It's not a race. A lot of you in here are also pretty young too. Even some that consider themselves maybe older are still only 40 or, maybe even 50, but you still got a lot of time to trade stocks. It's not like you're going to become a millionaire overnight. So just let go of that idea. If you think you're going to become rich tomorrow morning, just go ahead and just hand me the money in your portfolio now because you're going to lose it all anyway. Um, don't actually do that, but fundamentally, right? It's a marathon, not a race. Marathon, not a sprint, I guess is the right way to say that. So definitely, definitely, definitely just stick with one contract. You don't need to be trading anything crazy. You don't need to be trading the most volatile names in the market. Yeah, yeah, that's a good question. Can I touch on the PDT rule? If you don't have 25K in your account, you can only trade once every couple of days. Yeah, so while that's correct, if you're trading on a margin account, it's a super common kind of misconception. If you are looking to trade with under 25,000, which again, most of you, especially if you're new, hopefully are trying to do that. You shouldn't be trying to trade with your mortgage payment, on your first day. But if you are, more power to you, I guess. But if you're trading with under that amount of money, go ahead and open what's called a cash account. Robinhood has a cash account. Any brokerage pretty much will offer you a cash account. And a cash account allows you to essentially bypass the PDT rule. You can only trade your buying power in a single day, which honestly is a benefit. Some people were talking about, oh, I could trade twice my buying power in a day, which means essentially if you have $1,000, you could trade up to $2,000. And especially for new traders, that is a horrible idea. If you want to fast track to, again, lose all your money, just go ahead and send it to me and I'll help it disappear way quicker than that. Regardless, if you're looking to trade, just get a cash account. You could trade up to your balance in your portfolio every single day. If there's a bank holiday, it'll take a day to settle or a day extra to settle. But again, right, a lot of beginners just don't have the discipline, right? They don't realize that they don't need to be trading every day. They don't need to be in every trade. At least for me personally, and this is a mistake I've already made this year, funny enough, but I guess it happens. There's a time and place to be involved in the market, right? There's a time and place to be trading breakouts. And kind of right now, the market's a bit on pins and needles, right? The distribution days are stacking up if you're kind of been paying attention to the charts. So not a bad time to kind of take a back seat, relax a little bit, focus on your charts, focus on your education. You don't need to be trading every day. And I guarantee you, every single successful trader, really successful trader in the billions or hundreds of millions is going to tell you the way they made their money was not taking trades, but it was doing nothing. That's when the real money is made, right? Knowing when to sit out, knowing when to protect your capital. And again, this isn't meant to turn into too much of a trading psychology lecture, but still definitely an important message here. You will not make more money by taking more trades. Full stop. It's just not how it works, right? More trades does not equal more money. Such a common misconception that so many people fall into the trap of thinking, oh, if I take every flips trade and every VC every single day, I'm going to make more money. And it's like, that probably won't happen, right? Realistically, that's just not exactly how the market works, right? Focus your energy on getting those high probability trades. Focus your energy on finding those trades. Focus your energy on learning more about the market and your education rather than trying to get into every trade at every time in every market. You're just never going to do it right. You're going to overwhelm yourself. One trap that I fell into as a beginner, even when I first joined here, I guess I didn't mention, when I first started out trading, I actually joined Only Options as a member all the way back in 2020. And one of the first problems that I had was taking every single alert. I took literally every alert. And I think I still have a screenshot of my portfolio. I was trading on Robinhood at the time with about $1,000. And I had found myself into probably like 10 positions at a single time, every single one of them red. And as a beginner trader, that is just about the worst thing that you can do for yourself, is just thinking, oh, if I take more trades, I'll make more money and I'm going to get rich quick. No. So if you guys take nothing from this lecture tonight, hopefully you at least take that. Take less trades, sit on your hands more, be more patient. There's no reason to rush. The market's not going anywhere. You don't need to trade every day. That's one of the better skills, at least that I learned in recent times, is just being able to be patient, being able to sit out of the market and just say, yeah, it's not an environment for me to trade in. I'll wait. I'll be more patient. As traders, we should be looking for opportunities to make money easily. Why should we work harder for more challenging market environments? No reason, right? We have the flexibility to not all of us maybe, but hopefully most of us have the flexibility to not trade for our living. So we don't need to be in a trade at every moment, or we don't need to be making money in the market every day, right? It should be supplemental to whatever else you got going on. All right, last question, then I'll move on here. If hedging a position, wouldn't there be more upside in purchasing a put versus a covered call? If so, why the covered call? Yeah, a little bit more of a higher level question, or I guess deeper level question here. Generally speaking, if you're trying to sell a covered call, or right, there's two ways to think about it. If you're buying a put to hedge as opposed to selling a call, you are investing more money or putting more money in the market to purchase that put. And a put is a directional trade, right? In order for you to make money on the put, the price of the equity has got to go down. Whereas when you're selling a covered call, obviously you're capping your max gain on the shares, but you don't need to put any more money into the market in order to get that protection. So kind of two frames of thinking. If you really need to hedge, for whatever reason, it kind of depends on how your portfolio is balanced at the time when you're taking that hedge. So it's hard for me to issue some kind of blanket recommendation to say, oh yeah, if you're in shares, always buy a put, always get a covered call. But anyway, what are my thoughts on Robinhood Legend? Yeah, I haven't looked into it at all. I have no idea anything about it. I just know it exists. You're in this as a new trader looking to make this your full time. Is that realistic? Yeah, it's definitely not unrealistic. But I will say, if you're looking to make it realistic, you can't treat it as a hobby. You got to treat it as a job. If you treat the market like a gambler, or if you treat the market like a casino, you're going to get treated like a gambler. And I think everybody knows what happens with gamblers, right? The house always wins, and you lose money over time. So that's kind of my spiel for you there. You gotta invest in yourself if you're looking to do this full time, and even if you're looking to do this successfully, right? It's not something that you can just say I'm going to do for fun. It's not supposed to be this fun little thing that you do like playing pickleball, right? If you're going to take it seriously and get good, you got to actually invest the time into your education. And you're doing the right step by being here tonight, and hopefully you stick with us for the next 11 classes. But yeah, it's definitely possible to make it full time. I highly encourage you to if you really want to make that a reality, set some goals for yourself, and find ways to work towards those. And understand the psychological implications of that too. One thing that I always keep in the back of my mind is, if I'm only trading for my income, right? If that's it for me, there's a lot of kind of psychological pressure there, right? The pressure definitely increases to be in those trades that are profitable all the time and not taking any losses, type of thing. And it's just unrealistic in the market, right? Some of the more successful traders will lose 8 out of 10 trades and be wildly profitable. So you got to really know yourself, and when you're trying to jump into that next step. Ro, we'll talk into that a little bit more, but I want to just address one point of your question that's a bit of a concern to me. You asked how to know what call option or call or put option to take to make max profit. The last thing that I'll talk about from a kind of trading psychology point of view is that when you're trading in the marketplace in general, the first thing that you should be thinking of is your risk, not your profit, right? You always need to be defining and understanding what is the max you could lose, not the max that you could make, right? It's always easy for us to think about the max amount of money that we can make, but it's definitely much more difficult to think about the max amount of money that we can lose, right? As humans, we want to be right. We want to make sure we're making money. Money obviously increases the amount of pressure psychologically. However, you got to be considering what is the maximum amount of money that I can lose? Where is a point on this chart that I will say I'm wrong and I'm going to sell, cut my losses, move on to the next trade? Yeah, really, really good questions, everybody. Yeah, I definitely sorry I got off on a little bit of tangent while we're looking at the option screen. Let's keep it going. I don't know if we have a psychology lecture on the class schedule. We could probably just toss that in there just to kind of, it's definitely a really important topic. But I don't want to keep you guys too much longer than, the hour and 15 that we've already been in. All right, let's keep it moving. I'm gonna, unfortunately, I'll try my best to ignore some of the questions. Recording is going to be downloadable and recordable or available. It should be available by tomorrow. All right, a couple more terms to define here: in the money, out of the money, and at the money. So a couple examples. Again, I'm going to kind of blow through this. We have about probably 10 more slides to get through tonight, so I want to try and get through it all before we call it quits. In the money is a term. Let's first take a step back. This is going to be an example scenario. So let's say, for example, I am trading a call. If a call is in the money, that means the stock price is higher than the strike price of the contract. So what that would look like is if I buy a 90 strike call and Apple is at $95 per share, that contract is in the money. A contract that is out of the money for a call would be when the stock price is lower than the strike price of a call contract. Oh, yes. So let's say, for example, if you buy a 90 strike call contract and Apple is at $85 per share, that contract would be out of the money. And at the money would be if a stock price is equal or very close to the strike price of the call contract. So one example is if I buy a 90 strike call and Apple is at 90, that contract is at the money. Or if I buy a 91 or an 89 strike contract, you could probably just consider those at the money because they're so close. And this graphic, which is just the options train from what used to be TD Ameritrade, might help explain this a little bit further. So basically, what's shaded gray are all the in-the-money contracts. The left side of the kind of graphic here is the calls, and the right side of the graphic here are the puts. And this is one kind of thing that always is hard for me to teach. I feel like I've never really found the best way to teach this to people. So I'll do my best here, but basically the way that I like to think about it is if a call or put is in the money, that means if we exercised it, it would be worth our time, right? So remember, if we exercise a call, that means we have the right to purchase shares at that strike price. So we wouldn't want to exercise an out of the money call, right? That would mean that we need to pay more money for shares than we do right now. Like if we exercise a 310 strike price call, we pay $310 per share for shares when the price is $299. So that doesn't make any sense, right? So out of the money is kind of what I think about. If you were to exercise that contract, it's just dumb, right? There's no reason to ever do that. Whereas in the money is when if I were to exercise that contract, it would do something for me, right? So again, if I exercise the call that's in the money, that gives me the right to purchase shares at say 285 when the stock is at $300 per share, right? So that's a good, trade-off there. And, there's some caveats to that, but fundamentally at a high level, that makes sense. And same idea for the puts, right? Let's say, for example, I have an in-the-money put contract at the 310 strike price. What that means is I can sell my shares for a higher price than they currently are if I were to exercise that contract, which that's great, right? That's exactly what I want to do if I was using the put contracts for their fundamental purpose. Now, as you'll probably learn throughout your time in the Discord server, is that most people in here, I'd say 99.9 probably have never exercised an options contract, and I'll say 99% probably never will. It's not something that's done super frequently in here, but definitely is, something that can be done. So we got to talk about it and make sure you guys know what that is, but not going to stress too much about it tonight. All right, so we're going to move on to our first question. Hopefully this helps us kind of nail down those in the money and at the money terms. I want you guys to really pay attention to the problem statement. I'll read it out aloud as well, and then I'll have you guys go ahead and put your answers in the chat, and we'll talk about it if there's a lot of people that are kind of wrong or right or whatever it might be. So first question, I have a call. It's highlighted in italicized and bolded for a reason, contract of SPY. The strike price is $395. SPY is currently trading at 412.24. Is this contract out of the money, at the money, or in the money? Go ahead and put your answers in the chat. Once we get a couple answers, we'll talk about them. So I'll give you guys about 20, 30 seconds. Looks like a lot of you guys are on the same page. Cool. Yeah. So I don't think there's much to explain. It seems like every single one of you got in the money there. Yeah, deep in the money. Yeah, for sure, deep in the money there. So nice one there. All right, next one. I have a call contract of SPY. The strike price is 412. SPY is currently at 412. Is that out of the money, at the money, or in the money? Go ahead and throw your answers in the chat. Yeah, this one's kind of a gimme. All right. Yeah. All right. I'm going to warn you guys. The next one is not a trick question, but every time I give this lecture, people answer twice because they listen, then they answer it the wrong way, then they do it again. So listen and read carefully. I have a put contract, not a call, a put. The strike price is 420. SPY is currently trading at 412. Is this out of the money, in the money, or at the money? All right, everybody's on the same page today. Miko said out. Oh, we got a couple people saying out of the money. Why do we think out of the money? I will say the answer is in the money. Well, I'll just explain why the answer is in the money. So again, if we go back to our graphic here, right, remember that in the money puts are going to be higher than the current stock price. So let's say, for example, in this example here, stock price is $299. So our in the money puts are 305, 307, 310, 312, 315. So our in the money puts are higher than the stock price because remember, if we are exercising a put, we would want to sell our shares for a higher price than what they're currently trading at, right? So in this specific example, the strike price is 420 and the SPY is currently at 412, meaning that if I exercise that put, I can sell my shares at 420 instead of 412, which would be good, right? Again, obviously some caveats to that. You have to pay for that options contract. So, there's a kind of push or pull there, but for the most part, for those who answered out of the money, does that make sense as to kind of why it's actually in the money? The put always trips everybody up. I think calls are just more intuitive to think about, which is why I focus more on them. But hopefully that helps clear that up a bit. All right, cool. Let's keep rolling, everybody. You guys are doing great. We're almost there. I know we're a bit over time. Kept you guys for a long session tonight, but the bell doesn't dismiss you. I do. All right, two main things that make up the premium of an options contract. They are called extrinsic value and intrinsic value. Very simply put, intrinsic value is the amount that a contract is in the money. So we'll talk about an example of this. Basically, you can think of intrinsic value as the value of a contract for the reason that it exists, right? And contracts exist to be exercised. So if it's super in the money, it's going to have a decent amount of value. The extrinsic value is mostly comprised of your value based on time, right? The time till expiration or your implied volatility, right? As volatility rises, the price of contracts also rises. As the time till expiration increases, the amount of the price of a contract also increases. So let's talk through an example here. I have a call contract to SPY. The strike price is $395. SPY again is trading at 412.24. The ask price of this contract is $24.59. And again, remember, if the ask price is $24.59, that means the total price that we pay is $2,459 because we need to multiply by 100. The intrinsic value is very simply calculated. All we need to do is subtract the current price of the shares by the strike price. So the current price of the shares themselves is $412.24 minus $395, which is the strike price. So we are $17.24 in the money. We multiply that by 100 to get our option pricing, and all of a sudden we have an intrinsic value of $1,724. So if that contract expired that day, that moment, all this intrinsic value or extrinsic value would go away, and the contract would be worth $1,724. The extrinsic value calculation, if you were trying to calculate that on its own first, it's certainly much more complicated. So it's much more simply to calculate if you just subtract the intrinsic value from the premium, and you get an extrinsic value of $735 here. And again, just to reiterate, the intrinsic value would be the price of the contract if it expired that exact moment. So let's say, for example, that was expiration. This $735 would disappear, and we would only have $1,724 left. Again, just to reiterate, this is not a calculation that you're going to be doing on a real regular basis, but kind of sticking with the intent of this course series, we're going to explain everything to you, kind of like you're a beginner and kind of like this is a college class. And funny enough, I actually did end up taking a college class on this at one point just because I was kind of curious, and this was something that we covered, so I felt like I wouldn't serve you guys well if I didn't cover this myself. So anyway, again, not something that we talk about or really you're ever going to do, but just something to be aware of. All right. There's a couple advanced option strategies that, again, we kind of deferred to a future or just not beginner lecture. Selling premium or selling to open calls or puts, that's a more advanced strategy. There's some other option strategies that you can do where you buy a call and sell a call of a different strike price. That could be some kind of a spread. So there's debit spreads where you pay a net amount to get that spread, or credit spreads where you receive some amount to take on that spread. And then finally, there's even more advanced option strategies that, could be four legs, four different calls and puts, different combinations, like an iron condor, a straddle. Again, these are things that really, really aren't commonly traded in here, but just something for you to be aware of that, hey, they exist. I could do this. I could learn more about them if I wanted to, but just not something that's super relevant for us today. All right. So I want you guys to start thinking of your question. Just because we're over time, I'm going to keep rolling and give you guys a summary of what we talked about, just a quick kind of preview of what we got going on next class. So go ahead and toss any questions that you guys have in the chat, and I will get to them once they show up. If there was any that I missed or skipped earlier, just go ahead and toss them in there again, and I'll get right to it. Just to kind of summarize and wrap up what we talked about today. Today we talked about, again, high level, basics of the stock market, basics of options contracts. We also kind of threw in a little bit of a discussion on psychology. As you guys ask me these sorts of questions, you can definitely get me kind of derailed off the topic. So I'll do my best not to get too derailed, but I get excited about some of this stuff. So hopefully you guys don't blame me for getting distracted if you guys ask some good questions. Next class, we are going to talk about the Greeks, which is maybe a term that you guys have heard before, but basically this is what actually makes up the premium of an options contract. And this is what is kind of put into the options pricing formula to spit out a price of an options contract. So as an options trader, really, really important that you understand the Greeks, because this will absolutely make or break the trades that you are taking. As I mentioned earlier, just because the stock price goes up doesn't mean you're going to make money. And if you're not paying attention or don't even understand the Greeks, full stop, you're going to get destroyed. I mean, if you don't understand how contracts move, you shouldn't be trading them. Just like if you don't understand how to drive a car, you shouldn't be driving a car, right? It's the same thing. If you don't understand how options work, you should absolutely not trade them. All right. And again, in the next class, we'll also talk a little bit more about selecting options contracts too. We'll start to kind of talk about that and give some kind of general guidance. Selecting options contract for a trade is a super, super nuanced discussion. There's a lot of kind of experience that will really help you get to the point where you need to get. And there's just so many different scenarios where you could change the contract that you trade. That's just going to come down to answering you guys' questions on different scenarios and probably workshopping some different topics. But all right. So we got a couple questions here. Robinhood does simulate your returns. Yeah, so you could use Robinhood to get kind of a rough simulation of what the profit or loss may be of a contract based on specific stock price. Will we be teaching level 2 in time and sales at some point? It's not currently planned for this lecture series, but depending on your guys' kind of demand and how excited and how attendance kind of keeps up throughout this course series, I don't know about you, MMA, if you're still around, but I personally have no objections to adding maybe a wild card of 4 classes just throughout the course. If you guys really want to talk about level 2 time and sales, I'm not going to act like I'm, the best person to fully cover that. We could definitely have, probably myself and River talk a little bit more about that, or myself and Tilio talk a little bit more about that, because there's super, super detailed nuance to that sort of thing. And it's not something that I use on a day-to-day basis, so I can't act like I'm the expert. So would want to probably bring somebody else in there. But yeah, absolutely, we can cover that. Is the expiration date every Friday? Yeah, for the most part, options contracts expire on Fridays. For some different stocks, it's a bit different. Like some, you have Monday, Tuesday, Wednesday, Thursday, Friday expiration, so every single day of the week on some like the S&P and the Qs. But yeah, not always every Friday. Are you able to see the pros when they open their positions? When I see alerts, I can't tell if they've already opened them. I want to see when they open. I guess I'm not exactly understanding what you're referring to. Are you referring to like the analysts in the server, like when they open and close positions? If so, the answer to that question is yes. So let's see if I can find an alert from recently. I mean, here's one that I know of recently. MMA recently posted he's purchasing NVDL at this price, and he's purchasing shares. So this is a pretty simple alert here. Zabes, we could probably see something similar. This is an alert where he is purchasing Amazon 117, 230 strike calls at $3.10 a piece. He gives a stop here as well. And then this is where you can see he's starting to sell. So he said he's trimming some Amazon calls at 355. Empanada probably does something similar. Yeah, so you can see he uses an acronym buy to open, or BTO, Tesla, this expiration, this strike price at this price. He gives an update on the profits there, talks about how he got stopped out in profits. River probably does something similar as well. So he's been giving a lot of his alerts in VC recently, so it's a bit more different. But hopefully that kind of outlines the point there a little bit. 1K has a bit more of a watch list style, so you can kind of see in the morning he gives his watch list for he's going to get calls on this name over this price or below this price, and the targets that he's looking to sell. Cool. Good question. Who assigns the analysts names? That's a really interesting point. Themselves, a lot of them are just kind of nicknames that we've kind of come up with. I guess this is Tilio. I don't honestly know why he calls himself this, but it's not his name. Zabes, I think it's reasonably public information, but this is kind of part of his real name. Empanada, I don't actually know what Empanada's real name is, honestly, but I don't know why he called himself that. Nando, I'm pretty sure his name is Nando, so that's why he's Nando. Ava, no idea why her name's that. River, no idea why his name's Dirty River. Magician, yeah, I'm not sure. Anth is just an abbreviation for his real name, Anthony. So again, it's just kind of all over the place. It's just normal usernames, I guess, but there's no specific rhyme or reason to why everybody. It's a great question. Why everybody? Oh, Dark Magician is from Yu-Gi-Oh. He's a real magician. Yeah, there you go. Yeah, Ro, that's a very interesting question that'll probably require a lot more explanation than what I'll give you tonight. But the question is, when analysts say buy calls over a strike price and when the stock price fluctuates above and below that break-even point, how do you know when to enter? It's really all about, for me, price action closes. So, for example, if you're looking at the 5 or 15 or 30-minute time frame, when that candlestick closes above that level, that would typically be where I would take entry on that position. It all varies on the type of trade. And again, as I mentioned, it's a question that could be answered with a whole lecture. So I'm going to probably refrain from giving too much detail and examples for now. But if you stick with the lecture series, probably in the next, let's go back all the way to the beginning. Yeah, it's 100% something that we're going to cover in a class. I just don't remember exactly what the name of the class is. So price action, volume, we'll talk about that. Support and resistance, we'll talk about that. Price targets and positioning, we'll talk about that. So there's really 3 opportunities for us to cover that exact topic. So we will absolutely, and we'll probably even touch on it in candlesticks too. So we'll definitely get there. All right, guys. Well, again, I want to really thank you guys for making the time tonight and bearing with us this first class. A little bit of technical difficulties earlier in the session, so apologies for that. But again, I really want to thank you guys for being here tonight. You know, again, it's something that we're really excited about. That I love teaching these classes. It's my favorite thing to do here. I would, yeah, love doing this. There's a reason I've been doing it for so many years at this point. And I really hope you guys enjoyed as well. One thing that I love to mention at the beginning and end of all the classes is if you ever have any feedback, any different classes you'd like to see, any different way that you'd like the information presented, if you're deaf and you can't hear, if you're blind and you can't see and you need things explained in a different way, please reach out. Please send me a message. Please send somebody a message and say, hey, I need this done for me so I can learn or understand better. I am very happy and would be excited to accommodate for any specific needs that you guys have in order to help this flow better for you and work better for you. So please just don't hesitate to let me know if there's anything that we can do to improve these classes for you. You know, I've been doing this for a while, but it doesn't mean I'm an expert. So I'm always happy to hear constructive feedback more than anything. I'd rather hear constructive feedback more than positive feedback, honestly. So any ways that we can improve for you, just please don't hesitate to let us know. But with that in mind, guys, that's really everything. We're going to be doing these classes for the next 12 weeks every Tuesday. If you guys are really fired up about it, you know, we can talk about extending it to maybe a 4-month period or stacking more classes in a week. So just give your feedback, guys. Put your feedback in the trade floor. Send your feedback to, you know, MMA or myself or, you know, whoever, the OT account, you know, whoever you want to send some feedback to. Just let us know what you guys thought about the class tonight and how we can improve for you guys. But yeah, hopefully this is, you know, maybe part of your guys' New Year resolution. You know, you want to get your trading behaviors together or just learn something new. So really excited to see you guys continue to stick with us. And I know we had a lot of you guys in here tonight and really hope we see you guys, you know, continuing with us throughout the next couple classes. And it's only going to get more and more complicated. So if you were bored tonight and you felt like this was a little bit below your pay grade, it's only going to get more and more complicated. So hopefully we'll catch up to your skill or knowledge level as we continue throughout the class. So that's really the end of my ramble. Anything else to add, MMA, if you're still here, or any kind of closing comments before we call it?
No, it was great. I learned a bit, and I hope you all learned. And I look forward to the next one next Tuesday at 9 p.m. Eastern.
Man, don't lie. You did not learn. You were not paying attention.
No, I paid attention. I like the
Yeah, I hear you
question.
smiling. I hear you smiling. You're lying.
You guys asked some good questions, and it takes me back to when I would, I used to trade. Someone asked how many cons you can buy, and I was thinking of the days I was buying thousands of contracts on TD Ameritrade, and I'm like, dude, I don't miss those days, man. But I know on Robinhood they definitely limit you, I think, like you said. So
Yeah, it's like
I
two
hope none of
grand.
you are ever in a position where where you're buying
No.
thousands of contracts unless you're high level trading, you know what I mean? So but I loved it. It was a great class and I look forward to next week because I love the Greeks and
No, you don't, dude.
intrinsic, extrinsic value. I love talking about that stuff and I feel like that's where my strengths are, especially in those things. When I first started doing options, that's what I wanted to learn, that type of stuff. But I need to brush up on it, man. I'll be honest, because I haven't uh cared
Oh,
to
that's all right.
the
There's
Greeks
a
in a
reason. That's
while.
the reason I'm talking and you're not.
Yeah, exactly.
All right, dude. One more question. Off topic, are there prop firms for options trading? Any thoughts on that? I have no idea.
I have no
I
clue.
I
Uh,
I I don't think prop firms are very good. I think they're a waste of most people's time. But anyway, um, you do you, but I don't know of any, and I wouldn't recommend any. And one other thing that you
I
guys
wouldn't either. I wouldn't either. I see them a lot, and if you have success with them, then
more power to you.
yeah, fair play. But to me, I've seen a lot. I've seen more people fail on those things. And obviously, it's a business at the end of the day. I would prefer to own a prop firm than to be
Yeah,
somewhere
seriously. Yeah.
investing or
There's
whatever.
a reason there's so many prop firms spinning up. They make
Yep.
so much money for
Yeah.
no like people just blow money on those
I
things.
get the
So
appeal to it, hey,
oh
I
for
can take
sure.
someone else's money, but
You
yeah.
can't though. There's so many
Yeah.
rules and regulations around it. It
Yeah,
just
exactly. I don't know too much about them to even speak on them, but no,
yeah,
nothing
Anthony,
really.
it's better that I don't answer that question. Just don't look into it. Don't waste your time and just trade with your own money because we're gonna be more well served by just not even getting involved with prop firms. But one other thing that I wanted to mention that I usually like to mention throughout these classes, and I know there's a diminished amount of people in here, so I'm not going to get out to everybody, but you'll hear, myself and other people recommend different things. I want to make it clear we're not sponsored or endorsed by anybody. It'd be awesome if we were, but the things that we recommend to you guys are really from our own personal experience. So when I recommend Robinhood or Thinkorswim or Anthony recommends, unusual whales or whatever he talks about, or SoFi, whatever, it's really all from our own personal experience and just figuring out what works and what doesn't. So hopefully that adds another layer of trust. Like we're not really trying to sell you anything. It's just, it's what we like and doesn't mean you're going to like it, but it's what we do.
Robinhood's great for beginners because it's designed as like I've said this for years. It's designed like a video game. So it's like it doesn't
Good and
it
bad for that
doesn't hurt as
reason.
much when you're losing money because it feels like it's not even real. It's their design is amazing. SoFi, no, their fills are so bad. I
They're good
feel
on shares. Their fills
horrible.
are good on shares.
Oh, okay,
Contracts,
yeah.
bro.
Shares on
Yeah, I
options
mean that's what I was
are
trading.
god awful.
That's what I bought QUBT on.
I feel horrible that I sent so many people to SoFi. I mean, they're great for their savings account, not gonna lie. Like there's some benefits for SoFi, but the trading, I don't really, yeah, they're not it. Maybe if you're buying shares though, right?
Shares are good. I've been liking the shares. I mean, I didn't like the QUBT. I don't know why it filled me so high. It should have filled
Uh,
me lower.
yeah, there's a way to set a stop loss in Robinhood. I mean, we could go all day answering these questions, but
Yeah.
well, we're gonna have a Q&A every 4 weeks,
Yeah,
and
I think the
yeah.
Q&A MMA will probably be a really good opportunity. Like I could even share my phone screen and just start like setting, just start taking
Mhm.
trades and
I
then
could
see what
literally
happens.
set a yeah, I could set a stop loss for you live. Like at this
Yeah.
point, we might as well just do stuff like that because
Yeah. Just pull up the
there's
port and start buying and selling shit.
well, I'm not gonna do that again. Last time you got me in a penny stock doing that
That
BS.
was so funny. What was that ticker again? I don't remember what that
I
was.
don't know. But
That was
I'm
good, dude.
saying, man, we have the experience just because we've been trained so long and I could name, various situations, no matter options, stocks, whatever it is, I've probably seen it. You know what I mean? So that's experience is obviously number one, but to learn from people who have the experience is vital as well. And I know a lot of you. Yeah, I try to always minimize my losses, right? So like as many I call them expensive lessons, but at the end of the day, I try to have as few of those expensive lessons as possible. But hey, that's how you learn. We've all taken L's here for sure. Toasty's taken L's, I've taken L's. At
And
the
I'll
end of
never
the
take it
day,
out.
yeah. At the end of the day, that's how you learn, to be honest. Hate to say it. Yeah, everyone here is going to take a losing trade no matter what. So it's how you learn from it and not to let it get under your skin and your emotions and try to chase that money back, because that's when you go down that, path where you're chasing those losses, and next thing you know, your port's down big and you're wondering how you got there. So that's happened to everybody, man, I promise you. So you got to try to avoid those situations as much as possible. But yeah, we could answer questions all day, but I think that's probably we should leave it for the Q&A. But I look forward to it every
Yeah.
9 p.m. Eastern, every Tuesday. Yeah, and we'll have
Yeah, it's
guests. Let's take some feedback. I'll send out a link and we can take some more feedback on this class.
Oh,
So
that's a good idea. Yeah, send out a
yeah,
poll or something, and we'll see. We can start to schedule some different guests to come in. Like, if
yep,
Flips wants to come talk about volume, if Tilia wants to come talk about level twos, if River wants to talk about types of trades, that could
yep,
make it even more fun too for everybody. Get to know
yep,
everybody. Yeah, that's a
yep.
good idea. And
We're
then I think we could
crystal.
even do like a podcast style lecture too, Anthony. We could do like a podcast on trading psych. That usually
Yep.
goes pretty well.
Yeah, and we could bring FaZe in here. There's a lot of at the end of the day,
Yeah, yeah, we
there's a
should bring
lot of
FaZe
people in
in.
here that you guys can
Yeah,
learn from. And
yeah, let's do
yeah,
that.
yeah,
All right, cool guys. Hey, appreciate you guys. Anthony, I have read books about trading. I will end up talking about them through the course of this lecture series, and you can DM me and I'll tell you what I've read. All right, guys, appreciate your time so much. It's been a pleasure, and hope to see you guys all in the next one. Have
yeah.
a great rest of your
See
night.
you
See you
guys.
guys.